Hello everyone, I am Zahra Pudra Mulya Nanda from Trisakti Institute of Transportation Logistics. I am excited to share with you this video presentation. So, without any further, let's get started.
Supply chain instruments are like handy tools that help businesses manage and make the most of their supply chains. They come in different forms, like methods and technologies, and they all work together to make things run smoothly and efficiently. These instruments have a few important goals. First, they aim to make the supply chain more efficient, which means getting things done faster and with fewer mistakes. Second, they strive to improve visibility, so businesses can see what's happening at every step of the supply chain. And finally, they help businesses make better decisions by providing them with accurate and timely information. This is when a buyer decides to pay the supplier before receiving the products. In return, the supplier gives them a discount. It's like paying upfront and getting a special deal. This helps the supplier with their money needs and reduces the risk of the buyer not getting enough products. Imagine you're a buyer and you really need some products from a supplier. Instead of waiting for the products to be shipped and then paying the full amount, you decide to be a bit proactive. You offer to pay the supplier in advance, but you ask for a discount in return. This way, you get a good deal, and the supplier gets the money they need to keep their operations running smoothly. It's a win-win situation because you get a discount, and the supplier gets their cash flow sorted out. Plus, it reduces the chances of you running into any supply shortages. Purchase order financing is when a third-party financing company provides funds to a business to fulfill customer orders. It allows businesses to access cash in order to cover the costs of production and delivery, enabling them to accept and fulfill more orders even if they don't have enough money on hand. Now let's say you're a small or medium-sized business supplying goods to a big and reliable buyer. But here's the problem. You need funds to produce and deliver the products, and you don't have enough money up front. In comes purchase order financing. You can take the purchase order you received from the buyer and go to a financial institution. They'll give you a loan based on the value of that purchase order, but the interest rates will depend on your credit rating. The cool thing is, if the buyer is well known and trusted, the bank may consider their creditworthiness as a guarantee, which means you'll get a better financing rate. This allows you to fulfill larger orders and grow your business. Buyer-backed purchase order financing is a type of financing where a small or medium-sized enterprise (SME) supplier obtains funding from a financial institution based on a purchase order from a reputable buyer. In this arrangement, the financial institution considers the buyer's creditworthiness when determining the financing terms for the supplier. Let's say there's an SME supplier that manufactures custom-made furniture. They receive a significant purchase order from a well-established furniture retailer for a large quantity of products. However, fulfilling this order would require a considerable amount of funds to cover the production costs. In order to secure the necessary financing, the SME supplier approaches a bank or a financial institution that offers purchase order financing. The supplier presents the purchase order received from the reputable furniture retailer as collateral to the financial institution. The financial institution assesses the creditworthiness of the buyer, the furniture retailer, to determine the risk involved in providing financing to the supplier. If the buyer financing terms, such as a lower interest rate or a higher loan amount. Based on the buyer's creditworthiness, the financial institution extends a loan or provides funds directly to the supplier. The supplier can then utilize these funds to cover the production costs, purchase the necessary materials, and fulfill the order from the furniture retailer. In this scenario, the buyer's good reputation and creditworthiness act as a guarantee for the financial institution, making it more comfortable to provide financing to the supplier. The supplier benefits from accessing the necessary funds to fulfill the order, while the financial institution mitigates some of the risk associated with lending to the supplier. Overall, buyer-backed purchase order financing enables SME suppliers to take on larger orders and expand their business by leveraging the creditworthiness of reputable buyers in their supply chain. In this scenario, a financial institution lends money to a supplier based on a document called a warehouse receipt. This receipt is like proof that the supplier has stored a certain quantity of their products in a warehouse. The supplier can use this document as collateral to borrow money. The amount they can borrow depends on the value of the stored products. For example, you're a supplier and you have a bunch of products stored in a warehouse. You need some cash, but you don't want to sell your inventory just yet. That's where warehouse receipt finance comes in. You can take a warehouse receipt, which basically proves that your products are securely stored in the warehouse, and show it to a financial institution. They'll give you a loan based on a certain percentage of the value of your stored products. The best part is, you still have control over your inventory. You can withdraw and sell some of the products whenever you need to, and the loan is based on the discounted value of the goods. Similar to warehouse receipt finance, here the supplier uses their inventory as collateral to get a loan from a financial institution. So, let's say you have a business with inventory, products waiting to be sold, that you can use to secure a loan. This loan can be used to cover expenses like expanding your business, buying new equipment, or restocking materials. It's like borrowing money while putting your inventory up as a guarantee. Trade credit. Trade credit is when a buyer gets a discount on the wholesale price if they pay quickly. But if they delay payment, they have to pay the full price plus some extra interest. It's like when you buy something and the seller gives you a discount if you pay within a certain time frame. If you pay late, you have to pay the original price plus some extra fees. Trade credit is a common way to finance short-term purchases in global trade. Imagine you have a small clothing store, and you want to stock up on some trendy new shirts to sell to your customers. You find a supplier who offers you a deal called trade credit. Here's how it works. The supplier gives you a wholesale price for the shirts, let's say $10 each. But if you pay them within 30 days, they'll give you a discount of $2 per shirt. So instead of paying $10, you only have to pay $8 per shirt. Now, let's say you're a bit tight on cash at the moment, and you can't pay the supplier within 30 days. You need a bit more time, so you pay them after 60 days. In this case, you have to pay the full $10 per shirt, and on top of that, you have to pay an additional interest payment, let's say $1 per shirt. So, if you paid within 30 days, you'd get the discount and only pay $8 per shirt. But if you paid after 60 days, you'd have to pay the full $10 plus the extra $1 as interest. Dynamic discounting. Imagine you're buying goods from a supplier, and they offer you a discount on the wholesale price if you pay early. But here's the twist with dynamic discounting. The discount rate decreases gradually over time instead of having a fixed discount rate for a specific number of days. So, if you wait a little longer to make the payment, you'll still get a discount, but it will be slightly lower than the initial discount rate. For example, let's say you receive an invoice from a supplier for $1,000. They offer you a dynamic discount of 2% if you pay within 10 days. However, if you decide to pay between 11 and 20 days, you'll still get a discount, but it will be 1.5%. Recourse factoring. Sometimes suppliers face cash flow issues because their customers take time to pay their invoices. Factoring comes into play here. It's a practice where suppliers sell their accounts receivable, unpaid invoices, to a financial institution at a discount in exchange for immediate payment. The financial institution takes on the task of collecting the payment from the buyer. For example, let's say you're a supplier waiting for a customer to pay a $10,000 invoice, but you need the money urgently. You sell this invoice to a financial institution through factoring. The financial institution pays you, let's say, $9,500 immediately, taking into account the discount. They then collect the $10,000 from your customer when it's due. Non-recourse factoring. In non-recourse factoring, the factor assumes the buyer's risk of non-payment. Hence the interest rate depends on both the supplier's and the buyer's credit ratings. Non-recourse factoring is like a financial solution that helps you get paid faster and reduces the risk of customers not paying. Here's how it works. Let's say you have an invoice worth $1,000 from a store, but you need the money now. Instead of waiting for the store to pay you, you can sell that invoice to a factoring company. They will give you immediate cash, usually around 80–90% of the invoice value, let's say $800. Reverse factoring. In reverse factoring, a reputable buyer initiates a funding scheme to help their suppliers. The buyer provides a guarantee to a financial institution for the transfer of the supplier's accounts receivable. This enables the suppliers, especially small and medium-sized enterprises (SMEs), to obtain financing at a more favorable interest rate because they are backed by the reputation of the buyer. For example, imagine a large retail chain that has numerous suppliers, including small businesses. To support their suppliers, the retail chain collaborates with a financial institution to set up a reverse factoring program. This program allows the suppliers to receive early payments on their invoices at a lower interest rate because the financial institution considers the credibility of the retail chain. Forfaiting. When an exporter wants to sell their accounts receivable, unpaid invoices, from an importer, they can use forfaiting. The exporter sells these receivables at a discount to a financial institution, the forfaiter, in exchange for immediate payment. The financial institution assumes the risk of non-payment from the importer. For example, let's say you're an exporter who has sold goods to an importer for $20,000, but the importer will only pay in 90 days. However, you need the money right away. So, you sell this accounts receivable to a forfaiter for $19,000, taking into account the discount. The forfaiter now waits for the importer to pay and assumes the risk if the payment doesn't happen. Letter of credit. A letter of credit is like a letter from your bank to the supplier, guaranteeing that your payment will be made in a specific amount and on a certain date upon the delivery of specific documents. This provides security to the supplier that they will receive the payment as promised. For example, let's say you're buying goods from an international supplier. To give them confidence that you'll pay, you obtain a letter of credit from your bank. The letter of credit states that once the supplier delivers the goods and presents the required documents, such as bill of lading, your bank will make the payment to the supplier on the agreed upon date.